If you spend any time on social media, you'll notice that there are a lot of new traders and investors, and some experienced ones, that seem to think the most important thing in investing or trading is being right. These market participants will go into a market-moving catalyst and bet entirely on one direction, because they think their job is to predict which way a stock or the market is going to go next. Nothing could be further from the truth. While as a long-term investor, I know that it's critical that I identify companies with stocks that I want to be involved with for the long term, I also know that over the long term, even good companies will go through bad times. Without illegally trading on insider information, there's no way for an investor to know if an upcoming catalyst will be positive or negative for the stock in advance. Yet the social media trolls have no qualms about going after an investor who was long into an earnings report, or a trader who was short into an earnings report and had the stock move in the opposite direction of the investment or trade. Thinking you always need to be right is almost a guaranteed way to lose money in the stock market or any market. In fact, most traders are successful and make a ton of money, even if they only have a 40% hit rate or less. That means that more than half the time, they're actually wrong with their trades. And when you're talking about investors, particularly venture capitalists, their hit rate is even lower. Some venture capitalists will only get 1 out of 10 companies right, yet they still make a fortune. How is that possible? The key about investing and trading is it's not about being right or wrong. It's about having a plan for both outcomes. For instance, when we look at one of my holdings, Shopify, with the ticker symbol SHOP, when it headed into earnings on Monday, it started to approach $92 a share. After it reported earnings, you can see that Shopify rallied 27.25%. But going into earnings, I took profits. Why was this? If we go back to February of this year, you can see that right before earnings, Shopify was at that exact same price point, right around $91. Once again, we're headed in earnings. It's a binary event. It can only have one of two outcomes. And so we don't know which way the stock's going to go. And in February, Shopify reported a terrible quarter, and the stock sold off horribly. In fact, from where Shopify was before earnings, around $91, to its bottom at August 5th, it sold off nearly 47%. That's right, the stock got nearly cut in half. So going into the quarter on Monday, I decided it was time to sell some of the position. So I sold 14.89% at $91.10. This sale locked in 56.56% in gains on shares that I only bought 3 months ago at $58.19 on August 1st. And the sale lowered my per share cost 5.56%. down from $68.30 to $64.50. Do I regret making the sale? Absolutely not. Even though I believe in Shopify for the long term, we're talking about a gain of 56% on those shares in just a matter of months. One of our top priorities as long-term investors is risk management. If you're not trimming some of your position after you've had a big gain, you're asking for trouble. Imagine all those Shopify investors back in February who went into earnings thinking it was going to be a blowout quarter, so they didn't take any profits, only to have their position get cut by half in a matter of months. Additionally, by making this sale, I have freed up capital that I can add back to my Shopify position if we see a systemic market-wide sell-off, or if something happens in Shopify's future and it sees a sell-off. This is not unheard of. Stocks in general are incredibly volatile. Additionally, I kept 85.11% of my position, so the vast majority of it experienced that significant pop we saw after earnings. After that sale, my position is now up 77% from my new cost basis. It's hugely profitable. And I always like to say I'd rather have a smaller position than I would really want, but have it be incredibly profitable, than be all in and down 50%. This is exactly why investors and traders aren't supposed to be trying to be right. They need to have a plan for both directions. What are you going to do if your stock heads higher tomorrow? And what are you going to do if your stock heads lower tomorrow? The answers to those questions will be very different for each market participant based on their own techniques and disciplines, their own strategies that they're applying for the markets. But for me, if one of my stocks heads higher, I will consider trimming the position. And if one of my stocks heads lower, I'll consider adding to it. And if it's nowhere near either of my price targets for buying or selling, then I'm just hands off and I'll hold on. The key to remember is it's not about being right. It's about getting rich. To learn more, check out my blog at getirked.substack.com.